Okay, guys. Hello, everyone, and good morning. My name is Sofia Veselova, and on behalf of CRELA, we welcome you to today's session, which is going to focus on comparing Vancouver and Toronto in terms of overall return on commercial real estate investment. For those of you who are not familiar with CRELA, we are a Commercial Real Estate Lenders Association, the leading association of lenders, brokers, and consultants in the commercial mortgage industry across North America. We are excited to host over 300 registrants today. I'd like to start with special thanks to our sponsors. Our event sponsor is Natural Granite and Marble, the leader in hotel and motel renovation projects in Canada. The company has extensive experience in the industry and collaborates with all stakeholders for the successful completion of the project. As an expert in the hotel renovation project, Natural Granite and Marble strives for excellence in quality and successful completion of the project within the. Our platinum sponsors today are Hanscom Loan Monitoring, trusted construction cost monitors and advisors. Hanscom Loan Monitoring has served Canadian and international building clients on a wide variety of construction projects for over 60 years. And Lorraine General Contractor that brings the technical pedigree and process sophistication of some of Canada's largest construction companies, yet delivered by their mid-sized firm. With offices in Ontario and Alberta, Lorraine General Contractor prides themselves as builders doing repeat business with their customers. Our gold sponsors today are and Finale. Once again, huge thanks to all of our amazing sponsors.
All right, thank you, Sophia, for that. And thanks everyone for tuning in today. Good afternoon, good morning, wherever you're joining from, whether it's Toronto or Vancouver or somewhere in between, somewhere on the East Coast. First off, I'd like to thank CRELA, Commercial Real Estate Lenders Association, for asking me to host this panel today. And I would also like to thank the 5 of our wonderful panelists for joining me in this discussion. With that being said, welcome to today's presentation on Vancouver versus Toronto. How do the markets fare in terms of returns in commercial real estate? So my name is Brody Cross. I'll be your moderator for today's event. I have had the luxury of experience in both markets. Both of them have very unique opportunities and challenges. So with that being said, I'd like to pass it over to our panelists, and they're going to give you a brief introduction of themselves, and then we'll jump into the conversation. So to start off, we're going to go to CBRE's very own Anthony Liang. Welcome, Anthony.
Thank you, Brody, and thanks, Sophia, for the invitation and for putting this event together. My name is Anthony Liang. I'm an associate director with the capital markets team over here in CBRE Vancouver. I specialize in investment sales, transaction advisory, essentially representing clients in acquisition, disposition of all types of real estate across British Columbia. I've been at CB for a little over a year now, or 5 years now, rather, and have taken part in approximately $15 billion of transactions during that period of time.
Awesome. So that's wonderful to hear. Michael, let's pass it over to you, also in Vancouver.
Thank you, Brody, and thank you so much for having me. Really excited to be here and share what I know and hopefully learn a lot about Toronto too. As I say, my name is Michael Emmert. I'm a principal of the Capital Markets Group in Avison Young's Vancouver office. I've been in Vancouver and with Avison Young since 2004. Prior to that, in Sri Lanka for a little bit, and London with Grosvenor before that. And again, happy to be here.
Awesome. We're glad you are able to make it. James Lang from Colliers. How are you doing today?
Not too bad. Yourself?
I'm doing good. Thanks for asking.
So I'm James. I've been with Colliers for the last 11 years, working in our investment division, specializing in investment as well as land transactions, completing over $6 billion of sales in the past 11 years. My background is in urban planning. I have a master's in urban planning from the London School of Economics. So I take a look at a lot of sites and highest and best use from the ground up and seeing that process through.
Awesome. Rob Walkowiak, I hope I pronounced the last name right. Welcome.
Almost close enough. Thanks, Brody. Glad to be here with everyone. My name is Rob Valkowiak. I'm a licensed real estate broker in the province of Ontario, working with Royal LePage Commercial, and have been exclusively focused on the investment sales market for my entire career. And that's taken place in the core of Toronto, but has also spread out into other markets outside of the GTA as well. I also manage our Royal LePage commercial office here in Toronto, where we have about 14 commercial brokers.
Awesome. Happy to have you here, Rob. And last but not least, with the name tag, Jeremiah Seamus. Welcome, Jeremiah.
Just in case you forget my name. Thanks for having me, Brody and Team Finio. So I'm based in downtown Toronto. I lead the private capital group here in Toronto. We specialize in selling buildings and land in the Toronto area in the Greater Golden Horseshoe. And we're specifically focused on the middle market. So roughly in the $5 to $75 million range. We're not as focused on the institutional capital side. And we exclusively work for owners of buildings and land in this space, and now we're starting to do a lot of work in eastern Ontario as well as Quebec too. So excited to be here. Thank you.
Awesome. Yeah, we're excited to have you on the panel as well, Jeremiah. So, and first of all, we're going to kick off the conversation by talking about multi-res land prices, how they compare between the two markets. So, briefly, I want to go over, so at the end of 2021 in December, we had a high profile site just north of Yonge and Dundas Square that sold at about $273 per buildable square foot. Jeremiah, can you kind of kick us off here in talking about the pricing for multi-res land sites in Toronto? What does that trend line look like over the past, couple of years, and where do you see that going in the future?
That's a good question. So in the last 10 years, there's been an 8% CAGR in downtown development land over, and this is mainly unzoned and zoned lands where you can effectively understand the density fairly easy. We're not talking about risky sites. Land now is trading at $211 a buildable foot on average. That's in the 416. And then you're seeing some pretty significant moves in land across the boroughs, the 5 boroughs and the 905. But the story last year was that 905 land really moved, I think, fairly significantly. I'm trying to remember the number. They don't have it here in number me, but roughly 13%, I believe, from 2019. Let's call 2020 the lost year, rather. But actually, in the last 3 months or so, we've seen a push downwards on land pricing, probably the first time in Toronto history. But there's still fairly significant numbers coming out, and we're coming to market with a high-rise site in the next month or so downtown. I think it'll be a good time to see exactly where that pricing will move, because construction costs have changed everything.
Yeah, just for some of our listeners on the West Coast, can you just distinguish what you mean in terms of 416 and 905? Specifically, we want to try and focus the initial conversation on more of downtown sites rather than those periphery nodes and Brampton, Mississauga, Etobicoke. Can you just distinguish between 416 and 905 just quickly?
Yeah, so 416 is the area code that Toronto uses and has traditionally been. There was the old city of Toronto, which is the downtown area now, and there was 5 boroughs and cities that amalgamated to be part of Toronto. So we're basically distinguishing between downtown Toronto land and suburban land that is outside in the greater Toronto area.
Okay, thanks for clarifying that. And I'm going to toss this one over to James in Vancouver. Jeremiah is saying around that. Sorry, you said about $211 a square foot, or just north of that. What are you seeing in the Vancouver market? Downtown sites are very hard to come by in terms of multi-res. Can you just talk about that and that pricing per buildable square foot? I know that you have a listing out on the Canby corridor that is well over $400 a square foot. How is this justified? You know, what are you seeing in your market?
Well, let's just start with the downtown market here because it's a good bellwether for the whole market. You know, leading up to 2018, we saw a real run up in pricing downtown, going from 250 a buildable to, you know, the peak market. There's a few sales along Alberni, which is, you know, first class neighborhood in Vancouver, where, you know, inclusive of CAC, which is essentially what you're going to have to provide the city to get entitlements for the market zoning, upwards of $850 per buildable at the peak. And this is largely driven by, you know, an influx of luxury buyers who are purchasing, you know, end sales units from anywhere from $2,500 a square foot to $3,000. The government did a great job in 2018, 2019, implementing a number of taxes, whether it be, you know, the foreign buyers tax, speculation tax, the vacancy tax, the school tax, numerous taxes pushing down that, you know, top end of the market. And we've seen downtown land pricing move down back towards kind of 500 to 550 per buildable, but there's been a real absence of trades. You know, a number of people are sitting on sites that they purchased, you know, 3 years ago, you know, waiting for the market to come back. Again, there's very little supply downtown to buy. So, you know, we do see that reinforced, and, you know, that is the bellwether for the Vancouver market.
Okay, so Anthony, what are you know, can you add to that point at all in terms of, you know, we can talk about maybe going a little bit further away from the downtown and how those prices are reflecting that, you know, the further you move away and those opportunity zones. Can you talk a little bit about that for us?
Yeah, absolutely. I mean, James put it very nicely, you know, with transactions in downtown just being very quiet in the last, say, 4 years now since the peak of the market. A lot of sites, you know, developers are kind of moving out towards the suburbs or not that much further away from downtown. And majority of them are obviously following the transit lines, where, you know, you're seeing a ton of developments happening in Burnaby, Surrey City Center, and all the way along the Canada line down to Richmond. And so those areas, we are seeing a ton of transactions, a ton of demand. But again, you know, it's hard to talk about residential land without talking about, you know, that transitioning over to multi-res and rental instead of condo, right? As James has touched on earlier, with all the government policies, CACs and whatnot, the rental housing has really become the next big thing. And a lot of that also comes down to the encouragement from the government, both provincial and federal, to build multi-res, including, you know, added density onto sites to encourage rental, as well as superior financing through CMHC programs to allow developers to build rental at a much higher rate of return and much less equity and way less risk.
For sure. Yeah, and that's a good point. So, you know, I'm glad you brought that up, and we can kind of, you know, use that. There's a couple other points that I wanted to get to, but why don't we have that, you know, transition our discussion right now into, obviously, you know, the demand for rental housing in both markets has soared over the past, you know, a little bit. A lot of people have been priced out of home ownership. The purpose-built rental market has largely been played by you know, small to medium-sized private groups historically. Have you guys, you know, Rob, we'll start with you on this one. Have you seen a shift in, you know, who's acting in that space of, you know, purpose-built rentals right now in Toronto?
I think there are a number of developers and investors trying to be active in that space, but there are a ton of hurdles in their way. I think you're really looking at either existing landowners with additional land, buildable land that they own, that they bought maybe many years ago, and they're looking at adding density to that site. You know, they have more options in terms of looking at purpose-built rentals compared to condos, because they're not paying for the significant premium that land is today. If you're looking at just a raw piece of land that you're going to go through some entitlements or to put some entitlements on the property. The pro forma is leaning towards condo developments for in order for those developers to reach their profit targets. So it kind of depends on when you're buying the land and how much of it you have. I'll just go back. I just want to touch quickly too on just the demand side, if I can, and take it back a little bit. I know we're talking about Vancouver versus Toronto here, and which is a little bit strange because I think both are world-class cities. But our investors are looking at how confident are they in their returns for in either market, and I think Toronto has some significant boxes that they've already checked as it relates to population growth, available wealth, and then obviously the increasing imbalance between supply and demand. So the city of Toronto is growing, planning to grow about 30% over the next 10 years compared to Vancouver, which is closer to 14%. And that growth is coming from new Canadians, Canadians moving back into the core, as well as that millennial population increasing based on where they like to work in the core. So there's a lot of these metrics as it relates to population and just growth over every single metric that really instills a lot of confidence in developers' focus on the city of Toronto.
So
can I just add too, we're seeing a lot of entrants in the purpose-built rental come in and take advantage of the CMHC program. Like a number of private investors, and they're mostly syndicators, are looking to do this, whereas traditionally it's been the pension funds. So I think this is very encouraging from what we're seeing. We've sold a few sites now to these CMHC type program, and there's a few more that are trying to do it in downtown sites. At the same time, still having sold the pension funds. I'd love to see more of that. And I'd also be curious to hear from the Vancouver guys if anyone's taking advantage of that program.
Yeah, for sure. RCFI financing was a big thing everyone was trying to take advantage of last year. Low equity, long amortizations, and low interest rates, really spurred a lot of local developers to pick up rental sites, whether it be in the Cambie Corridor or other areas of Vancouver, and then usually bring in a pension partner throughout the process, whether to take it out at the end. But, ultimately that local lead would have a small ownership stake and pension funds would be the ultimate owner.
Oh, that's incredible. Because the CMHC program, it really brings down the equity requirement where you've traditionally had a 25% of construction financing need. You've got someone who's taking way less equity into the project, therefore they can raise the equity from private sources and still hit that IRR return. So I don't know, it just, to me, I found it very encouraging when we've been seeing the last, call it 18 months.
Yeah, for sure. Definitely you're going to see a lot more of the CMHC, I think, moving forward. In regards to the construction financing, it's a little bit more difficult on the acquisition side if you're talking about stabilized assets, just with the velocity in the market right now, and both markets, Vancouver and Toronto, being able to close and have a competitive bidding process for these properties. It's very hard to close with CMHC financing given the turnaround time that they're requiring right now. But going back to housing prices here for a quick second, on Monday, I believe it was, RBC released an article saying that Toronto housing price index benchmark was at $1.26 million, which edged out actually Vancouver's, which was sitting at 1.255. So we're going to talk a little bit about regulations, because they said that a TD economist claimed that housing regulations in Toronto attributed to a 40% increase in pricing since 2018 compared to just a 13% gain in Vancouver. Jeremiah, can you talk about some of these policies or government incentives or lack thereof, whether it be inclusionary zoning or something like that, that's affecting the product coming to market and thus causing the increase in prices?
Well, it's a very interesting point, because I'll take you back about a year ago. So we had, when the market started to get smart on what's called inclusionary zoning, for those listening from Vancouver, it's effectively a policy that states any new project has to have an affordable component. And when it's condo, there's a sliding scale, but it starts at 5% and goes to upwards of 30% in some cases. But with purpose-built rental, there's no policy in place until 2026 that they require any affordable. But going back about a year ago, when the inclusionary zoning really became to be real, because it had not been put in place yet as law, but it was looking like it was going to be so, you had a number of developers looking to fill up their pipeline because they took a position that, you know, after effectively 2021, they're not going to have any types of sites they're able to buy because the landowners are going to take a discount on their pricing. But then what happened was in the fall of 2021, you had a lot of builders who had put sites under contract and needed enough time to put their applications into the city to be grandfathered into this. They really lost that time advantage. So people started to change their mind to, can we do purpose-built rental, or are we going to build zone sites? So that, I think that demand side is going to change drastically after September 2022, when it actually comes into place, if the minister actually conveys it. But after May of this year, you're basically too late to get an application in anyway. So we're seeing most of the planning done this year. And I think there's going to be a big change on pricing next year. Maybe not big, but certainly enough to make changes in what we had normally seen.
Okay, and Michael, I know there's some sort of inclusionary zoning in Vancouver. Do you mind just touching on that and, you know, what that entails for the Vancouver market?
Sure. Yeah, absolutely. Inclusionary zoning is something that we've certainly become very familiar with over here as well, throughout all the various municipalities. I think it's really came from a historical shortage of rental accommodation in Vancouver, which was really being felt in terms of difficulty to, you know, find rental apartments, but also very high rental prices. So the government locally put in a number of measures to incentivize rental development. Some of those were including 20% affordable housing in larger projects, but also additional density for rental projects, or maybe a fast track through the application process, because you didn't have to spend so much time negotiating condo CACs, for example. We've also seen rental replacement policies in municipalities such as Burnaby, where existing rental product has to be replaced if it is knocked down in favor of a higher density project.
Yeah. So one of the things that I want to, toss this over to Anthony is there's a lot of, social programs in the Metro Vancouver area. And one of the things, I know we just touched on CMHC and the RCFI program, you can actually, kind of get your foot in the door if you partner and work with social initiatives within that local government. Is this a really distinct advantage of, having all of these social programs, whether it be, for rental or whatever it might be? Is this a distinct advantage for Vancouver developers looking to, develop purpose-built renting while also accessing CMHC financing on the construction side of things?
Sorry, can you hear me now?
Yeah, I can hear you.
Yeah, so good question. I, with the affordable housing requirements or social housing, whatever it is, that the city is now looking to place into essentially every project, it certainly helps with some of the requirements that CMHC is looking for as well, right? Most financing that they offer requires, the rent to be a certain level. So having that affordable component could actually work in your benefit to a certain point. But obviously, depending on what, where you're building at and what the city is looking for, oftentimes it could also create a drag on your pro forma. right? Oftentimes you could be building at a potential loss, but obviously if you can break even, that'd be great. And also for a lot of local developers who are looking to potentially sell off those buildings and piece that affordable component off to an owner and not an operator. We've noticed a lot of larger groups, institutional groups, actually would not mind taking on that affordable component as it's actually part of their social governance program, and it's actually beneficial for them to have part of that within their portfolio. And in many cases, a lot of institutions actually look for affordable components, which has been something that we've not seen in the past.
Yeah, definitely an ESG component to any sort of project, whether it be in real estate or something else, is always a good process in the world we live in today. I also want to toss one over to James here. C2 zoning in Vancouver market is kind of under a review right now with the city of Vancouver. So if it enacted, the C2 zoning sites could be developed with just a development permit and no rezoning required, up to 3.5 FSR or a 6-story mixed-use building. Is this going to, drastically increase the value of these C2 zone sites, or are you just seeing it's going to be level across the board?
Yeah, so C2 zoning is one of the better zonings in Vancouver. Historically, it's entitled you to a 4-story mixed-use condo above retail development form. Back in December of last year, the city approved what they call the streamlining rental policy, which really just pre-approved taking those 4-story developments and doing 6 stories in rental. So, it was highly anticipated, and the city was just, they had already, pre-approved some of these rezonings. It really just streamlines the process. So in terms of timing, you're probably taking what was a 24-month rezoning to get a 6-story rental and condensing that in probably 12-month period. So it's kind of a marginal effect, but what it does is it gives certainty to developers and groups trying to get into the rental arena. So we'll see a premium on that type of land going forward.
And how much of a premium do you anticipate that being in terms of buildable per square foot on that?
I would say rental land, on average goes for about 200 per buildable, across Metro Vancouver. It's probably going to be anywhere in the 5 to 10% range. It's really just a time savings.
James, what are your soft costs in Vancouver? Because your land prices on a buildable basis are way higher than we are in Toronto. I feel like our construction costs and our soft costs are also significantly more.
Yeah, hard costs, you gotta talk week to week. Most contractors seem to hold pricing for 2 weeks right now. If you were to build a rental development mixed use, you're probably looking around $350 to $375 on hard, with another 40 to 50% softs on that. It depends if you can get, DCL waivers and, other softs that come from the city, but, softs are going up at the same rate. It's just, it's this inflationary environment that we're in right now.
Yeah, so I'm glad you jumped in there, Jeremiah. That was kind of what I wanted to steer this conversation into, is talking about A, construction costs, B, soft costs. I know, Anthony, you touched on CACs in Vancouver as well, but the ratio between price per buildable square foot and revenue, ultimately the developer has to work within that range. And Jeremiah, can you talk about that ratio between buildable per square foot pricing and revenue for developers, and then you just on that range that that margin that developers have to work within for to have their construction costs, their soft costs, everything, and also their developer profit?
Yeah, that's a good question. Actually, we don't really track that ratio very often. I know Ben Myers from Bullpen Consulting, he likes to track that matrix very closely. What we find more so important is kind of this ratio from hard cost to soft cost. And to give you an example, a well-known cost consultant did a report on this, and 10 years ago it used to be about 40% soft costs of hards, and today it's close to 90%. So James, to give you a little kind of conversely, what we're dealing with here is underwriting a site now. Hard costs in Toronto are roughly around the last tendering I heard was $411 a square foot, including CM fees, up to $425 a foot on hard costs, and soft costs roughly 90% of that. So we're dealing with basically, call it give or take $750 a square foot before you even make a single dollar, before you take tax out, your profit, and your, technically you could call debt service too part of that number. So it's making sites outside of the 416, as I mentioned before, very difficult to do unless you have internal construction teams and you have non-unionized labor. And it's changing the metrics of land, as we're seeing, as James, you're mentioning, every 2 weeks. Honestly, we're seeing the same thing. We've been in the market with a few sites, and we're actually seeing buyers saying this is the first time in history where land prices may have actually dipped a little bit instead of moving. Whereas, I mentioned before this 8% CAGR increase. So I don't know what's going to happen, but we need condo prices to continue, or else people are going to sit on their hands like the industrial market for land in 2009.
Yeah, that's a good point. Rob, do you have anything to add to that in terms of obviously the increase in construction costs and pandemic related shortages in labor adding to those, those additional costs for developers to complete successful projects in today's, economy?
Yeah, I from what I'm hearing, there's more risks related to construction pricing than there ever has been in history. And when you're planning to build a project in 3 to 4 years, and you're trying to put your numbers together today, with the dramatic increase of construction costs over the last 6 months, you're a little bit wary about where numbers are going to be in the future. So we're obviously seeing developers, they don't plan to eat those costs, so they're just going to pass those on to the consumer, the end buyer, and that's clearly, as you're seeing, price per square foot for pre-construction condos in the core increasing significantly. Jeremiah, you might be able to talk specifically to this, but I mean, they're probably nearing $2,000 a square foot for a nice condo in downtown Toronto. And again, that increase is probably matching the increase in construction costs. I don't see that changing. I mean, the narrative over the past couple of years has been increase in everything. When you look at other world-class cities, like even New York, we're significantly cheaper to buy land. We're cheaper to buy condos, and I think we only have room to grow. There was an economist yesterday talking about some of the details in the recently released Housing Affordability Task Force report, economists from Bank of Nova Scotia, and they were looking at Toronto compared to New York on a density per square kilometer standpoint. And so Toronto is about 450 people per square kilometer. New York's about 1,700 people per square kilometer. We have the space in Toronto, we have the infrastructure, we don't have the housing. So it's, unless supply rapidly increases, you're going to see increased pricing on a consumer standpoint, and obviously increased pricing on a construction standpoint, because there's just not enough out there.
Yeah. So, with a little bit of, obviously, Jeremiah touched on a little bit of downward pressure to land. I want to hop back to that in a second, but I want to toss over to the Vancouver guys. There's a huge, challenge in the Vancouver market, and obviously you have the Pacific Ocean, and then you have the mountains. So land does become much more scarce in the sense of availability, where you can build. Obviously, we saw what happened in Abbotsford this year with the flooding, and in Toronto, you can essentially sprawl. Obviously, that's not what we want to do, but the availability of land and access to it is much harder in Vancouver than Toronto. Does that, inherently drive up prices to the end user, or does it just make it more difficult for developers to create successful projects?
Yeah, I can jump in there. I think I was reading the same article that Rob mentioned about densities in various cities, and Vancouver actually turns out to be the most densely populated, and I think that's probably a factor of that land constraint that you mentioned. It's one of the oldest stories in real estate in Vancouver is that, yeah, they're not making any more land, and we've got the mountains, the US border, and of course the ocean to constrain us, and of course entertain us. But you know, that squeeze is felt particularly in the industrial sector, where we've seen land prices skyrocket to you know, $7 million an acre. It definitely does also, I think, maintain those high residential land prices as well.
Yeah, Anthony, James, do you have anything to add on that, or kind of what are the things that you're seeing in terms of, obviously there's some innovative ways that they're combating, especially the industrial issue of space. Can you guys comment on any sort of, you know, innovative ways to tackle that?
No, I agree with everything Michael's mentioned, and I just want to add that, you know, we also have, I believe this is unique to Vancouver, that we also have the ALR, Agricultural Land Reserve, to the east. So that's also a huge constraint to our market. Although we have seen a lot of that being released now or in recent years in order to accommodate for industrial. So we do see certain areas that are now kind of popping up thanks to that.
Okay, yeah. So, I mean, yeah, some of those places, you know, Aldergrove, Langley, you know, there is areas, Maple Ridge, even with, you know, places that are designated ALR. One of the biggest things, and Rob mentioned this with, you know, the new task force that came out is, you know, zoning requirements for, and I want Jeremiah to touch on this, is zoning requirements for buildings, you know, has, I forget the exact point that it is, but is there a, you know, an even further downward pressure on land in Toronto with something that came out in this 55 recommendations in the task force recently?
I mean, I think that was a blessing from heaven when we first read that, but you know, still time will tell whether it's actually going to come into place as law. But the downward pressure is coming from the inclusionary zoning policy, which is in effect now as of November 9th, 2021. And after September, or sorry, before September 18th or the later of the minister's approval of this year will be when it will be law. And in order to be grandfathered into that, you will have to have a development application deemed complete into the city. So that by deemed complete, that means not actually approved, but just have all the necessary packaging, architectural, and studies put into the city. And so we think that it's going to cause a significant down pressure on land prices next year, because if you have the same parcel of land today where you can build 100,000 feet and you can sell it at market pricing, after September, that same parcel of land will effectively lose about 6% of that GFA to affordable product. And on top of that, you have to pay GCs or DCs, development charges, on that affordable product. You'll still have to build it. It still has to be included in your building. It can't be changed in any way. And it'll be affordable for 99 years. So it's not changing anytime soon in our lifetime. So, you know, will it change prices of land? 100%.
And just, you know, thanks for that. Just an open question to, you know, any of the Vancouver guys. Is there anything that you can see, you know, any but remotely possible that you can see a downward pressure on land, or do you think it's going to, you know, the pricing is going to keep, you know, rising and rising?
I think we did see a bit of a correction in 2018, 2019. Feel free to jump in, James and Anthony, if you have comments. But let me take Burnaby for an example, because it's been a very active municipality in the last few years. When the city of Burnaby initially introduced its Metrotown development plan, there was a flurry of activity as people bought up sites that were identified for greater density. And a number of these sites had existing rental product on, and the community was suddenly concerned that a number of these rental projects would be knocked down. So the municipality kind of put the program on hold and introduced rental replacement measures that I've mentioned before. And that did have a correcting effect on pricing of land in Burnaby. So those kind of measures can affect pricing, as well as, we do anticipate a bump in interest rates. I think the market can sustain a little increase, but if the increases were to continue more over time, yeah, I think that would have an effect.
Although, Michael, I argue on that one, it did have that dampening effect in 2019, 2020, but it seems to be back to almost where we were, pre-levels. And, Jeremiah, we're probably 2 years ahead of you on the inclusionary zoning, where it's become a fabric of our planning culture now. And it seems like developers have adapted to it. And those increases have kind of come back over the last 24 months.
How much are you required to build buildings?
How much?
Affordable.
20% is.
And what is the metric of that affordable? Like, is it
CMHC minus 20? And when you're building in concrete, it is a drag on the pro forma.
So, we just had a touch on interest rates there. So, as a general rule of thumb, capitalization rates, will go up when interest rates go up. When the cost of borrowing increases, returns need to increase as well to maintain the same level of profitability. In the Toronto market for multifamily housing, we're seeing cap rates between 3 to 4.25, according to Collier's Q4 2021 reports. While in Vancouver, it's anywhere from 2.25 to 3.25. This distinct relationship between cap rates and interest rates almost, it reflects a risk premium. Because Vancouver's is, slightly lower, what does that say, Anthony, about the market? And do you think this means that it's more of a risk adverse or safer environment for investors when compared to the Toronto market?
I think that is, that's in a way, that's what investors are saying, but at the end of the day, they are also looking at growth factors, right? You brought up interest rates. With what we're seeing today, rates are obviously going up, or going to be going up this year, and it is certainly it's compressing the market to a certain degree. And for example, we're looking at retail these days, and retail products are trading in Vancouver between 4 to 4.5 cap now, which is something that we've not seen for a very long time. And I got a quote from our debt department this morning, and interest rates for retail products are in the low 3s, right? 3 to 3.5. So you have a 100 bips spread between what you're borrowing at, your cost of capital, and what you're getting in terms of cap rates. So that has a huge effect on your levered cash on cash return, right? And that really compresses it by quite a bit. So for investors to make sense of that and still be aggressive in their acquisitions, they really need to sharpen their pencils and expect a growth factor, that's going into 5 to 10 years in order to make sense of pricing today. Because otherwise, like you mentioned, the returns would look very thin in year one, right?
Of course. Yeah, and the importance of operating income. Maybe we'll toss it over to Rob here back in Toronto. What are you seeing in that retail space in terms of Anthony touched on cap rates in that low 4 range. What are you kind of seeing in the retail space? I know that you had a recent project in North York that we looked at. Can you just talk about that for a quick second?
Sure. Excuse me. So a similar narrative to Anthony. If it's in Toronto, if it's a decent chunk of land, if it's got a lease in place with let's say at least 5 years of term left with the tenant, you're between 4 and 5% cap rate on that income. Clearly, the market's pricing in the future value of that land because there is a higher and better use, which would be some sort of higher density redevelopment. But you know, there is a spread that needs to be met. You know, that property you're referencing, we had a number of developers very interested in looking at it because it was almost 3 acres of land. But the hurdle for them was the fact that there was a tenant in place for 5 years, plus they had a renewal, and for them to put their money there and wait 10 years, it's just not worth it for them. So there's a real limit in terms of paying for income, and what I guess buyers will pay for income, and we're not seeing it drop much slower than 4 on what I call long-term redevelopment sites in Toronto. And from a cash-on-cash return analysis, it's sometimes I scratch my head because you could likely have a better return if you put it into like a bank stock on the TSX and make a 4% dividend. But clearly, there's some confidence in real estate, obviously, and the long-term plans for a higher return. So it sounds like the narrative is very similar to Vancouver in that sense.
Yeah, no, exactly, and that's a good point, and I'm glad you touched on the cash-on-cash return. So, here at Finio, we do something called debt opinion letters, and that gives investment sales brokers such as yourselves an idea of what sort of financing options are available for specific properties. And one of the ones I actually recently did was I provided a debt opinion letter for a property on Fraser Street. Based on the listing price, it was an applied cap rate of 2.55% for a freestanding retail building with a AAA tenant. They had a 10-year lease in place with 8 5-year options, and their going in cap rate was 2.55%. So, I mean, where's the growth in this, and how are investors realizing these gains? Like, I mean, if you, from a cash on cash perspective, like this property would be about $25,000, of cash flow after debt servicing. That's less than 0.5%. Like you said, Rob, you can just go simply, you can go get a GIC that would produce higher yields. How is this not, dissuaded investors? Like, what are we doing here?
Looking at appreciation, I think.
I don't have a good answer for you either, but I will say maybe they're conscious of paying corporate income tax, so they don't want to show any. In Ontario we're 11.5% corporate income tax, so compared to say 12% in BC. So I mean, there's a benefit there, I guess, from not paying any income tax, corporate income tax.
Yeah,
I think just in general in Vancouver, people have an affinity for hard assets, rather than putting money in stock market or, other more volatile things where they can actually go see it. And then again, the underlying land on Fraser Street, it's probably a C2 site. Again, that income, that capital growth over time, drives people to really low cap rates. And we've seen a number of those transactions in our market.
Yeah, the initial cap rate doesn't always tell the whole story. I think, there's other metrics too, like the dollar per square foot and replacement value, the future redevelopment value, the increases that you might have in a lease over the time. If you do have 8 options of 5 years, are they at preset rents that might show the right kind of growth? But yeah, the flatter the income curve, the more the cap rate's going to matter at the start.
Yeah. So obviously, touching on a lot of it is necessary, maybe even land banking, but you're just paying price per square foot. Has this, Jeremiah, can you touch on this? Like, has this, valuation kind of taken over, and has the importance of operating income kind of lost its aura now, or, what are you seeing?
Well, it hasn't lost its aura. Yes, it's taken over, but it's mainly because you have a lot of new entrants into the real estate space. So in the last 10 years, there's been a growth of the private investor. Last year, 72% of the buyers for all investment sales in Toronto were private, whereas 10 years ago, you saw that less than half, and you saw a lot more institutional REITs and traditional investors buying. So we're seeing a lot of private money come into the market and just looking for a straight cash on cash return. And in some cases, they're not even looking at the metrics of what the deal is. They're trying to place large amounts of capital into what they believe is a safe haven. And so they're taking a bet on what Toronto is and the greater Golden Horseshoe going to be in the future. And that's basically your demographics play, safe. And I mean, prior to these crazy lockdowns, but it's been a safe and, accessible place for people to live in that's been welcoming to every type of person across the nation. So, in the world. So a lot of these private investors are just coupling on top of that and looking to place large amounts of capital, whether it be from a business they sold or a property they owned for their business before. So it's becoming quite a bit more common.
Yeah, and that's a big thing, just placing money somewhere. And so obviously, let's toss this back over to Vancouver. Jeremiah touched on, just property appreciation. Do you think there's more, given the scarcity, back to the scarcity of land, is there more opportunity for increases in property appreciation versus Toronto? Anthony, if you want to take a stab at that one, or?
Sure. I mean, fortunately, I don't have a crystal ball here, but in my opinion, a lot of it is really attributed to government intervention or rather the lack of sometimes, and how slow some of the cities can respond to this surge in demand. So, with the limited supply we have here all across Metro Van and limited supply of land, that is, and how slow the city can move in terms of increasing density in many areas, I do think there's still going to be a lot of room for appreciation. Of course, I think interest rate is something that's going to be very critical to whether or not that actually happens. So I think that's something we probably want to keep an eye out for. Otherwise, I think there is still room here to grow for sure.
Awesome. And Michael or James, do you have anything to add on that point there? Or do you think, how much room is there to grow in terms of pricing in the Vancouver market?
I think the value of the land continues to be tied to the revenues that you can make from it, and we saw a bit of a drop in condo prices at the start of the pandemic, while single-family home prices actually performed very well. But we've seen those condo prices come back now to, in some cases, pre-pandemic levels. And I think so long as there is still growth in those revenues, then yeah, there's still some growth possible in the value of the land. But inflation might affect what people can pay for condos as we go forward. So yeah, probably still some room, but we have seen corrections before, and will again.
But I think in the long run, there's still that supply-demand imbalance that, Vancouver traditionally has, welcomed between 30 and 40,000 immigrants, on average. And, we're getting a little bit of an elastic band effect here where, we're going to be getting over 55,000 in the upcoming years. Same time, housing starts are kind of in the mid 20,000s. And, we're trying to play catch up before, and, we're just behind the 8 ball, and it's just going to put more pressure on land and demand in our marketplace, even regardless of some of the rising interest rates.
Yeah,
I'll also add some context to James's point there from the Toronto perspective. I think we're welcoming about 120,000 new Canadians into Toronto this coming year as well, and that number is going to increase as the whole country's target of welcoming new Canadians increases. And as well from a supply standpoint, we're building in Ontario somewhere between maybe 30 and 40,000 new units on average. I think the highest previous one was 80,000 units in 2020. We have a 1.2 million home shortfall in the province of Ontario, so we've got to build many more units than 80,000 per year to meet that demand. So we're in the same boat as James, but times a couple.
Yeah, obviously both markets are under obviously a huge amount of pressure in terms of trying to meet that demand. And, you know, one of the recent reports just came out that 90% of the sales, you know, have been to investors. So, you know, maybe we'll see a shift back. But you know what, we're approaching our final minutes here on the webinar. So I just want to kind of wrap up with one last thing, and it's just a question of, you know, what's the market velocity for you know, overall in commercial real estate, Vancouver versus Toronto. You know, is the market fully priced? Obviously, we just spoke that, you know, there still is room to grow. How much? Obviously, time will tell. And like Anthony said, none of us have the crystal ball here. But you know, Jeremiah, what are you expecting from the Toronto market going into obviously still in Q1 of 2022? What's the velocity like going to be this year? Is it going to be lower because of you know, shortage in supply, or where do you see it heading this year?
It's a good question. I'll be quick, but last year there was a 31% increase from 2019 year over year. So the velocity was fairly incredible. The number of transactions went up by 23%. So what we will see this year, we've seen so far that the velocity is increasing. I don't think we will hit the highs that we did in 2021 because there was a lot of money sitting on the sidelines from 2020 that got pushed into 2021. So, but we're certainly still going to see a significant amount of volume above our 10-year moving average.
And James, what about in Vancouver?
Yeah, similar story. You know, a lot of money sitting on the sidelines, probably even for 2020, go back to 2019. And, you know, as we headed into the latter half of last year, we kind of exited the recovery phase and started more of an expansion phase in the market, where we started seeing the vacancies come back to, you know, say landlord or favorable levels, and we're seeing, you know, rent growth. So we're going to see more projects going forward. In terms of velocity, you know, I see it kind of on par with 2021 in terms of activity.
Anthony, Michael, do you guys have anything to add to that, or Rob from the Toronto standpoint?
Yeah, we're starting the year with a lot of land on the market. So do anticipate it's going to be a busy year, maybe not quite as many trades as last year, but yeah, 2022 is going to be still busy, I think.
Good stuff. Okay, well, with that, you know, obviously it's very evident that both markets are, you know, performing strongly right now. In terms of total returns, it's very hard to distinguish one from the other. Both pose their unique challenges, unique opportunities, whether it be asset class based or in terms of, you know, revenue or whatever it might be. But at the end of the day, we'll see how both markets perform moving into 2022. I'm really glad that all 5 of our panel members here made it and contributed very well. I want to thank them, and I also want to thank all of our attendees for today's event as well, and also Commercial Real Estate Lenders Association for hosting all of us today.
Thank you very much, Brody.
Thank you.